In this video, I want to talk about my top 5 stock selection criteria. If you've been with me in my past videos, you've seen me talk about economic analysis and how I use that analysis to allocate my assets to various asset classes. Well, today I want to talk about my favorite asset class, equities or stocks, and the criteria I used to select the stocks that I put into my portfolio. For those of you who are new to my channel, my name is Jared Ayers. I'm a CFA charter holder. I've been doing this invest for yourself thing for about 20 years now. I've done really well, and I've created this channel to share with you all of the things I've learned, good, bad, and ugly, and the way I now think about investing that has proven quite profitable for me in recent times. So let's get into it. So I just want to recap a few things on how I think about equities a little bit before we jump into my specific selection criteria. So firstly, I'm not a purist in terms of any one specific strategy. So you may hear that an investor is perhaps a value investor, or a growth investor, or a momentum investor, or a trader of some sort. I believe that there are many attributes that need to be looked at in order to determine whether a stock is worth buying. I don't believe that being a purist in any one of these sort of categories actually captures all the attributes that I would be most interested in when I'm looking for a stock. So I do take elements of each of these strategies together when I'm looking at my selection criteria, but I definitely would not put myself into any one of these boxes per se when I'm looking at equity investments. I also want to mention just a really quick note on indexing. What I'm going to talk about today is my selection criteria for specific equity investments, so specific stocks. And I know there's a big trend right now for index investing or passive investing. I absolutely believe that for the majority of people who may be managing their own money, I think indexing is an excellent strategy. I think if you have a very small amount of money to invest, say under $10,000, then absolutely I think you should buy an index, because you probably don't have enough money to sort of diversify properly, even in my limited view of what diversification means. I also think if you have billions of dollars to invest, I don't think it's worth your time looking at individual securities. If you have a ton of money to invest, if you're a fund or what have you, then honestly, how effective are you going to be as a stock picker if you have to allocate that much capital? It just doesn't seem super plausible to me, unless you're like a Warren Buffett and you're going to go buy in the private markets as opposed to the public markets. Also, I think unless you have the time and the skill to actually go out and do the work you need to in order to find the stocks that are actually going to outperform the market, then I think indexing is really the best strategy. And also there's the element of volatility and literally just having the intestinal fortitude to withstand the fluctuations in the market. Not everybody can do that, and you really have to know yourself before you jump into this kind of game. And of course, if you are like most people, I think, and are very emotional potentially around movements in the market, then I think indexing is a much better strategy. And even in that, I mean, as we saw sort of through late 2018, even the index holders we're probably selling a lot, as you saw the S&P 500 come off very sharply. So even the passive investors don't always act passively with the indexing strategy, but at least I think it's a good strategy, because it does give you a broad diversification and really doesn't require a ton of homework or time in order to actually make those investments. So that's my opinion on indexing as well. So now to get into my top 5 stock selection criteria. So at the very top of my stock selection criteria, I always look at the return on equity. So why I look at this, the pop quiz answer is because it's a measure of management's effectiveness to allocate the company's equity. Okay, fine. What does that mean? Well, a high return on equity means that each year a large portion of earnings will be added to the net book value of the company. So as an example, if the return on equity is say 20%, it means that the book value of the company will go up by 20% year over year. Looking out 4 years, the book value should more than double at that compounding rate, assuming return on equity holds at 20% for each of those 4 years. So if you look at the price to book value ratio, something I pay attention to, assuming that ratio holds, then the increase in the book value of the company should track the increase in the price of the stock over the same time period. So that, to me, is something I want to see happen, and also if I can find a company that can generally hold or consistently have a high return on equity, it means that there's going to be a pretty good chance that the predicted, or my ability to predict the future price of that company is also going to be very sound. So, and that's kind of my hurdle rate, is around 20%. I don't really bother looking at companies that are below that unless I'm looking at companies that are growing into that kind of rate of return. So it's high. It doesn't return a lot in terms of potential candidates, in terms of the stock selections I make. So, but it is definitely very much at the very top of my list. The number 2 criteria that I look for is the price earnings ratio, which is a measure of value. So again, or you can, I guess, flip it on its head, and you can look at the earnings yield, which is exactly the opposite. It's the earnings divided by the price of the security. So what this tells me, effectively, given the price I'm paying today, how long will it take in years for me to recover my initial investment in terms of earnings per share that are basically mine as a shareholder. So, obviously lower price earnings ratios are better, or higher earnings yields if you want to do it that way. For me, that's not the end all be all of value, but it's a great starting point in terms of selecting which securities to look at. If you look at the high flying stocks, sometimes that are new and upcoming, potentially in tech, they'll have price earnings ratios that are kind of off the charts, into the hundreds even, and you've got to wonder, maybe there is growth there. Often, there is, but you do have to question whether there is, and how predictable that growth will be over time. So for me, lower price earnings ratios are a great way for me to find stocks that really hold some value. And of course, if they can return a lot on equity, then that's going to bode well for the future as well. So the number 3 on my list as stock selection criteria really has to do with that element of growth, so the price earnings to growth ratio. This, you can look up how the calculation is done, but it's basically the price earnings ratio as the numerator divided by the annual earnings per share growth rate that the company can generate. So it is forward looking, which can be a challenge, especially for a company that doesn't really control its future, I guess. And if its earnings are less predictable, then you got to sort of look at that growth rate, which is usually, you can come up with your own. You can look at what the analyst consensus are. You can look at what management is providing in terms of guidance. There's a few ways to get at it. Obviously, if it's an industry where the company can control, either they have a monopoly, or they can control the price of whatever they're producing. If they have long-term contracts with their customers, so that future earnings is quite predictable, then that makes that ratio quite a bit easier to believe. but it's still, I want to make sure that the price I'm paying for a company is sort of in line with what the growth rate is. So generally speaking, PEG ratio of less than 1 is what I'm looking for. So what that would mean is if a company has a price earnings ratio of say 10 and an annual earnings per share growth rate of say 10%, that would be a PEG ratio of 1. So that would be sort of the hurdle level that I would be starting to look at. And of course, if it has a higher growth rate for say a fixed PE ratio of 10, then that's going to be better, and of course the opposite would be true as well. So that's sort of the number 3 on my list. Does the price earnings make sense based on what the estimated growth rate of the company is? The number 4 criteria that I look for when I'm screening for stocks is debt level. So obviously debt is or introduces an element of risk to most companies, and of course that has to be looked at in conjunction with the nature of the company. So if it's in the lending business, then it will have a high amount of debt usually, if you think about banks and so on. So you do have to look at that relative to the industry norms and what a reasonable amount of debt would be for that company. I mean, obviously looking at its ability to generate operating cash flows relative to interest payments, and what is the nature of the debt, what the interest rates are, and those types of things. But as a quick scan, I mean, debt to total capital is a good screen tool that I use in conjunction with the first 3, just to see how much leverage might be in a prospective company. And the number 5 criteria, at least that I use for my initial screens, is market cap. So I mean, you can have all of these ratios, and they can be applied to a very, very tiny company, sort of the nano cap, under $50 million type size companies. To me, these companies often are far too small to, there's just too much risk in them. The chance of them succeeding can be quite varied. Even if everything looks like it's going in the right direction, it doesn't take much for a very, very tiny company to get thrown off and end up falling in the opposite direction. Because of how I like to structure my portfolio, I like to make meaningful positions in the stocks that I purchase, and I wouldn't want to put very much in a really, really tiny company. So that's also part of the reason is I just, my position sizing in order to manage the risk that I believe I'd be exposed to just wouldn't make it interesting enough for me to follow. So that's basically it, my top 5 stock selection criteria. I will leave some notes on each one of these criteria in the description, and you can follow up there. But again, number 1 being return on equity, number 2 being price earnings or earnings yield ratio, number 3 being price earnings to growth ratio, number 4 being the debt level in the company, and number 5 being market cap. So that's what I wanted to share with you today. I hope that was helpful. If you did find this video useful, please don't hesitate to hit the like button. Also, if you have any comments, questions, opinions, even if they're different from mine, please feel free to enter those in the comment section. If you're new to this channel and you want to subscribe, or if you've seen me before, then please always hit the subscribe button at any point in time. And of course, if you do want to see me cover different things in the future, then please also include those in the comments as well. So I do hope you did find this video somewhat useful, and yeah, until next time, thank you very much for watching.